Hello and welcome back to the Financial Freedom Show. If you're new to the channel, please be sure to hit the like button and subscribe in order to stay up to date with the latest videos we post on this channel. And if you haven't already, please be sure to join the membership in the description. That way you can have your name featured at the end of every single video that we publish, as well as access to our private Discord. And without further ado, let's get into today's video. As you noticed, a lot of the videos on my channel recently have been about SCHD, and that's going to continue to be the case just because it seems like you guys are enjoying those videos. I'm going to do a video shortly about my YouTube analytics and going over what you guys are enjoying and what you guys are not enjoying content-wise in the numbers, and we'll discuss what the future of this channel looks like. But forgive me because I'm starting to get sick, so my voice might sound a little off today, but I'm going to continue to post episodes for you guys regardless, so hope you enjoy. Without further ado, let's talk about SCHD. The Schwab US Dividend Equity ETF, commonly referred to as its ticker symbol SCHD, is a popular exchange-traded fund that has garnered attention among dividend investors. It's managed by Charles Schwab Investment Management, and SCHD is designed to track the performance of the Dow Jones US 100 Dividend Index. This index is comprised of 100 of the highest dividend-yielding U.S. companies that meet specific criteria for quality and sustainability of their dividends. SCHD is often applauded for its simplicity and cost-effectiveness, as well as its focus on delivering consistent income to investors. Some of the key features of SCHD are its low expense ratio. SCHD boasts one of the lowest expense ratios in its category. It's currently at 0.06%. This means that for every $10,000 invested, the annual fee is only $6. Low fees are crucial for long-term investors as they help to maximize net returns over time. Something else I'm going to do in this video is go over SCHD versus other dividend ETFs and how it compares, and how it's going to outperform in 2025. The second thing is focus on quality companies. This ETF emphasizes companies with a proven history of paying dividends. To be included in SCHD, companies must not only have a high dividend yield, but must also pass rigorous screens for financial health, including strong cash flow, manageable debt levels, and sustainable payout ratios. It has sector diversification. SCHD's holdings span multiple sectors with a heavy focus on financials, consumer staples, healthcare, and information technology. This diversification helps reduce risk while maintaining exposure to various economic drivers. The fund distributes dividends quarterly, making it an attractive option for income-focused investors. These payouts can either be reinvested for compounding growth or used as a source of passive income. While SCHD's low costs and high dividend focus are well documented on this channel, there's a few lesser known aspects of this ETF that are worth exploring. The first is its historical dividend growth. SCHD is not just about high yields, it also emphasizes dividend growth. The fund's underlying index selects companies with at least 10 consecutive years of dividend payments. Additionally, these companies are ranked based on a 5-year growth rate, ensuring a focus on firms that can grow their payouts over time. This makes SCHD appealing not only for current income, but also for investors seeking long-term wealth accumulation. There's also an exclusion of certain high-yield stocks. Unlike some dividend-focused ETFs, SCHD intentionally excludes companies with unsustainably high yields. These yield traps may significantly affect underlying financial instability, which could lead to dividend cuts or poor stock performance. By avoiding such companies, SCHD prioritizes stability and reliability. There's also an emphasis on free cash flow. A unique feature of SCHD is its consideration of free cash flow in its screening process. Companies with strong free cash flow are positioned better to sustain and grow dividends, even during economic downturns. This metric adds an additional layer of quality control to the fund's holdings. Next is outperformance during market volatility. SCHD has demonstrated resilience during periods of market volatility. Its focus on quality dividend payers, often mature, financially stable companies, tends to provide a cushion against market downturns. For example, during the market crash in 2020, SCHD's decline was less severe than that of many broad market ETFs. It has a relatively low turnover ratio. The fund's turnover ratio is significantly lower than that of many other ETFs. This indicates that SCHD's holdings remain relatively stable over time, minimizing transaction costs and tax implications for investors. It's tax efficient due to its structure as an ETF and its low turnover ratio. SCHD is tax efficient. Investors often benefit from lower capital gains distributions compared to mutual funds, making it an attractive choice for taxable accounts. And lastly is strong long-term performance. Since its inception in 2011, SCHD has delivered impressive total returns, often outperforming other dividend ETFs and even some broad market indices. Its combination of capital appreciation and dividend income makes it a well-rounded investment. So is SCHD right for you? SCHD is ideal for investors who prioritize dividend income, value stability, and seek a cost-effective way to invest in high-quality U.S. companies. It's especially suitable for retirees looking to get passive income, or investors who are younger and focused on investing dividends over time for compounded growth. However, as with any investment, SCHD is not without risks. Its performance is tied to the health of the U.S. economy and the dividend sustainability of its holdings. Additionally, its sector allocations may not align with all investors' preferences or goals. The Schwab U.S. Dividend Equity ETF, or SCHD, has earned its place as a top choice among dividend-focused ETFs. Its low expense ratio, rigorous quality screenings, and emphasis on both yield and growth set it apart from a crowded field. Beyond the well-known benefits, SCHD's attention to free cash flow, tax efficiency, and avoidance of yield traps highlight its thoughtful design. Whether you're a seasoned investor or just beginning to build your portfolio, SCHD offers a compelling way to achieve steady income and long-term growth. SCHD has consistently positioned itself as a leading dividend ETF due to its disciplined selection criteria, low expense ratio, and strong emphasis on both yield and growth. When comparing SCHD with other dividend ETFs such as VYM, which is the Vanguard High Dividend Yield ETF, DGRO, which is the iShares Core Dividend Growth ETF, and DGRW, which is the WisdomTree US Quality Dividend Growth ETF, several unique factors suggest that SCHD could outperform in 2025. What sets SCHD apart is its stringent screening process, which prioritizes quality and sustainability of dividends. The fund's methodology focuses on companies with a minimum of 10 consecutive years of dividend payments, strong cash flow to debt ratios, and high return on equity. This results in a portfolio of high-quality stocks with the financial resilience to weather market volatility. By comparison, VYM casts a broader net, emphasizing on higher yields without as much focus on quality metrics. This can expose investors to higher volatility in downturns due to the inclusion of companies with less stable dividend histories. DGRO emphasizes dividend growth, but often includes companies with lower yields, which might not appeal to investors seeking substantial income in the near term. DGRW focuses on quality and growth, but it comes with a higher expense ratio of 0.28% compared to SCHD's 0.06%. SCHD strikes a remarkable balance between yield and growth. Its dividend yield has historically outpaced DGRO and DGRW while maintaining competitive growth metrics. This dual advantage positions SCHD as an attractive choice for income-focused and growth-oriented investors. For example, DGRO and DGRW typically favor companies that reinvest earnings into growth, resulting in lower immediate yields. Meanwhile, VYM's focus on high yield often overlooks dividend growth potential, which can limit long-term total returns. SCHD's unique positioning within this spectrum allows it to deliver consistent income while benefiting from the compounding effects of dividend increases. SCHD's sector allocation further supports its potential to outperform in 2025. The ETF leans heavily towards sectors such as technology, consumer staples, and healthcare, which are areas known for resilience and innovation. These sectors are poised to grow in the next year, where economic uncertainty and market shifts might favor stability and adaptability. In contrast, VYM has a significant exposure to financials, a sector that could face headwinds in a high interest rate or recessionary environment. DGRO's broader diversification might dilute returns, while DGRW's focus on growth-oriented sectors could underperform if markets favor value-based strategies. SCHD's deliberate allocation ensures it remains well-positioned across different market conditions. With an expense ratio of just 0.06, SCHD remains one of the most cost-effective options in the dividend ETF space. This low fee structure ensures that it has a larger share of returns that flow back to its investors, enhancing its long-term performance. By contrast, DGRW's 0.28% and other dividend ETFs with a higher expense ratio may erode net returns over time, particularly in flat or bearish markets. SCHD's historical performance highlights its ability to deliver superior risk-adjusted returns. Even during periods of market volatility, the ETF has demonstrated remarkable stability and consistent income generation. Its focus on high-quality companies ensures that dividends remain sustainable even in challenging economic conditions. While past performance is definitely no guarantee of future results, SCHD's track record suggests that it's well equipped to navigate the economic landscape of 2025. With exceptions of slower growth and potential market volatility, SCHD's focus on quality and resilience set it apart from its peers. Several macroeconomic trends bolster the case for SCHD's outperformance in 2025. Lowering interest rates and focus on quality stocks could favor SCHD over broad ETFs like VYM, which may struggle with volatility in sectors that are sensitive to interest rates. Additionally, SCHD's emphasis on companies with robust financials positions it well to capitalize on a possible economic recovery or stabilization. Investors seeking both income and growth will find SCHD's strategy compelling, particularly in a market environment that rewards resilience and sustainable dividends. While other dividend ETFs offer their own strengths, SCHD's unique combination of quality, yield, and cost efficiency makes it a standout choice for 2025. So what are you doing in your portfolio? Are you buying SCHD? Be sure to leave a comment down below. I'd love to hear from you. If you enjoyed today's video, please be sure to hit the like button and subscribe in order to stay up to date with the latest videos from the Financial Freedom Show. And if you haven't already, please be sure to join the channel membership below in the description so that you can have your name featured at the end of every single video I publish, as well as get access to each video I publish a day early, and also have access to our private Discord. So thanks for watching, and I'll see you in the next one.